Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. Now, as you know, this show is all about your personal finances, and we speak a lot about mutual funds because, let's face it, they form a large part of almost everybody's portfolio now. That wasn't the case always. A lot has changed over the last 5 years. And over the last 5 years, there has also been quite a bit of a change in the disclosure norms. That is, what mutual funds are asked by the Securities and Exchange Board of India to disclose to you, the investor. Whether you're talking about the liquidity of the funds that they manage, or you're talking about the relative performance of their schemes. And all of this data becomes important for you when you're deciding which scheme to invest in. Now, in January of this year, the Securities and Exchange Board of India came out and said that there is a new disclosure that is required to be made for all equity schemes in the mutual fund space, and that is the information ratio. It's possible that you haven't heard about it. We're going to talk about what this means, how it is calculated, and how it stacks up against the other various ratios that you see out there. There is, of course, the Sharpe ratio, the Sortino ratio. There's also the simple standard deviation. There's alpha. There's so much to talk about. But to understand what the information ratio is and how you should read it, I'm joined in studio today by Ramesh Mantri, who's the CIO of White Oak Capital AMC. Ramesh, thanks so much for taking the time.
Thank you, Alex.
So let's talk about this information ratio. It was rolled out, as I understand it, in January. And of course, it will take a little longer, as these things normally do, for a lot of people to pay attention to this. First of all, what is it and how is it calculated?
So the information ratio, the idea is to evaluate active managers.
Okay.
So how do you evaluate active manager, and the fundamental role of an active manager is to beat the benchmark. Because remember, the passives exist for the benchmark. So the way to evaluate an active manager is adding value or not is to evaluate the performance of a manager with the benchmark. Now, what you do in this ratio is, first in the numerator, you look at the performance of the scheme versus the benchmark. If the number is positive, the scheme is outperforming. If the number is negative, the scheme is underperforming.
That's alpha versus
outperformance,
loss, right?
Simple versus the benchmark.
Yeah.
Now, the issue with this simple number, looking at just simple number, the outperformance or underperformance with the benchmark is, these numbers for a variety of managers can be very volatile. So how do you judge the consistency of performance? I'll give a very simple example, something that everyone in India can intuitively understand, because simplify the message. Let's say you're two cricket players. One cricket player scores a century in the first innings. We, of course, love that player. And the second innings, the player goes out for a duck.
Right.
What is the average? 50, which is a good average in Test cricket. Right? It's still a very good average in Test cricket, a great average, actually. Another player scores a 60 in the first innings and a 40 in the second innings. The average is what? 50. But the experience is very different, because 100, you think this player is genius, and then you get hugely disappointed when you get the 0. But the 60 and 40 gives you a lot of confidence in the player. So it's exactly the same average, but how that average has been achieved are very different routes. And that's what often happens with investors is, you love the player who scores a century, the fund which is the best performing, you put money in it, and if that fund goes through a bad cycle, which goes to a zero runs, often people want to exit that fund. So while the average of the fund is still good, but because of that volatility of performance, most investors have a bad experience with the fund.
Right.
So the regulator, the whole idea of information ratio is not only just to judge the quality of performance, but the consistency of that performance. So how do you calculate this? First, you look at the outperformance or underperformance versus the benchmark, often simply understood as alpha, and you divide it by the volatility of alpha.
Okay.
So not the returns, but the volatility of alpha.
So how do you calculate the volatility of alpha?
So what you do is you calculate, let's say for every month, the fund return and the benchmark. You look at the difference of that return, you actually square that number, because you want that number to be always positive. For every month, you add that number. You add all those numbers and then do a square root. Slightly mathematically complex.
Sure.
It's exactly the same approach you calculate standard deviation, by the way.
Right. Okay.
Exactly the same approach. The numbers have changed. Here you calculate the standard deviation between the fund return and the benchmark.
Understood.
Yes.
Okay.
Let's say in a Sharpe ratio, you calculate between the fund return and the risk-free rate. That's the difference.
Sure. Okay, so let's drive home this point, right? Because ultimately, and correct me if I'm wrong, because I'm understanding this along with my viewers, which is that the information ratio is supposed to tell you, okay, are you beating the benchmark? Yes. And are you beating the benchmark consistently over a period of time? What is the deviation from the mean?
Yes, exactly.
Right? So if you have beaten the benchmark by 5 percentage points, and let's say, that is your average, you've beaten by an average of 5 percentage points, then your information ratio should tell you if it is a high number, then the deviation is significant from that 5%. Is that correct?
Exactly right.
Right.
So what we look at is we divide alpha by the standard deviation of alpha.
Yeah.
So just give you how to interpret the information ratio. First of all, if the information ratio is negative, which means the alpha itself is a negative number, then of course the manager is underperforming. Right. So that's always a bad number to evaluate any active manager. If the number is, this ratio is below 0.5, which means the manager has outperformed, but there's probably inconsistent skill. It's very difficult to say whether there's a skill or not.
Right.
If the number is 0.5 to 1,
right,
which means the manager has good skill.
Sure.
Has a good skill in beating the benchmark. And if the number is 1, above 1, that means it's a very strong.
Fantastic. So the higher the number, the better it is, because because the number of times that he has deviated from that is not significant.
Yes.
So he's been more consistent than everybody else, and he's certainly been better than the benchmark.
Yes.
Okay. Now, you mentioned the Sharpe ratio, which also looks at risk-adjusted return.
Yes.
Right? Why is this different from risk-adjusted return? The difference is that there is no benchmark involved. Is that correct?
No. So Sharpe ratio applies to evaluate any fund, whether it's active or passive. What does Sharpe ratio do? It looks at the performance of the fund, and looks at this outperformance over the risk-free rate.
Okay.
Yeah. So whatever, let's say you can evaluate an equity fund, you can evaluate any kind of fund, but it looks at first the difference over the risk-free rate and divides by the volatility of the whole performance of the fund, not the alpha.
Okay. Okay.
Yeah. So here the deduction, one place is risk-free return, one is benchmark. Now for equity fund, if you have to evaluate an equity manager, you have to deduct the benchmark. So let's say for a large cap fund, it will be the large cap index, a mid cap fund will be a mid cap index. But if you have to calculate the same ratio for the Sharpe for a large cap fund, you will actually take out the risk-free rate. Right. Which is the bond rate.
The 10-year benchmark
which is often
yield.
The proxy for,
Yeah.
So one is looking at risk-adjusted return. One is a measure of skill of an active manager. Two different things.
Okay.
So you can calculate a Sharpe ratio even for a passive fund.
Right.
But you can't for an active funds, the real measure is information ratio.
Yeah, because you are comparing an asset, a risk asset, with a risk-free asset. Yes. In the case of a Sharpe ratio, you're calculating equity versus a risk-free return, which is government bond.
Yes.
Okay. So, by the way, and I understand that what we've just discussed is something that may have veered into the technical a little bit. But I'm here to tell you that if you've got questions, please do write in and we'll try and figure it out and we'll try and get those questions answered. The long and short of it is, and what I've understood, I'm going to ask Ramesh to listen to what I'm saying and to stop me if I'm saying anything wrong, is that the information ratio is a better measure for an equity fund manager, active equity fund manager, than the other measures. And the reason is that it will look at the outperformance of the fund against the benchmark, and it will look at the consistency of the outperformance against the benchmark. And so a ratio that is close to 1, that is between 0.5 to 1, is good, but a ratio at 1 or beyond is even better. So this is something that you should look at when you're deciding which fund to invest in.